Hello and welcome to Scale Up Smarter with Artemis Clark. For those of you who are new to this podcast, hi, I'm Kate Clark and I'm on a mission to help business owners and finance leaders transform their finance function using automation and AI. And today I want to talk to you about something that sounds incredibly simple, but it will completely transform the way you look at your business numbers. I want to talk about budgets, forecasts, and specifically how to build them in Xero. Now, I know the word budget doesn't sound the most exciting thing, and for a lot of people, it probably sounds like a bit of a restriction, a complicated spreadsheet, and actually something, why do I want to do this? And I completely get it. When I first started out with my business, I really resisted setting myself targets. I personally hated the thoughts of budgets, and I think it was because I didn't want to feel a failure if I missed those targets. But I've come to realize that actually that isn't the way I should be thinking about budgets. And hopefully by the end of this podcast, you'll understand why. So in today's episode, I'm going to talk through why you might want to use budgets, specifically in Xero, how to set them up, and most importantly, how to turn a simple budget into a rolling forecast that will give you a much better picture of your profit and loss as the year progresses. Let's ask the obvious question. Why bother? Why would you spend time to create a budget in Xero when you already have your bookkeeping up to date and you review a monthly P&L from Xero? Well, the reason is that monthly P&L report is looking backwards. It's telling you what has already happened. Your budget, however, is telling you what you expected to happen. And if you create a forecast, this will show you what is likely to happen next. So when you have a budget in place, you can compare your actual results against expected results. So for example, instead of just saying, we made £5,000 profit this month, you can say, well, we actually expected £8,000 profit this month, but we only made £5,000. Why was that? Or we expected £20,000 of sales, but we actually made £27,000. Brilliant. Can we work out where that extra 7,000 came from? And let's see if we can then replicate that activity to make more income in the future. So the value is not creating the budget in isolation. It's the questions that the budget will then help you ask. Because once you have that visibility, you can make decisions earlier. You could adjust your spending. You could potentially chase more of those sales. You could potentially review pricing. And you can think very carefully about dividends. You could also decide whether now is the right time to invest or pause. Without a budget and a forecast, you often only find out something has gone wrong after it has already happened. And of course, a budget just created once and ignored is purely admin. But a budget reviewed monthly is a really valuable management tool. Let me quickly explain the difference between a budget and a forecast, as the words often get used interchangeably. So our budget is our original plan. It is what you expect the income and costs to look like over a period of time, whereas your forecast is your updated view. Typically you would do this quarterly, but sometimes you might want to do it earlier if there's been a material change in your business activities. So you would look at the first quarter results, compare against your original budget and say, are we on track? Has anything changed? Do we need to adjust these numbers? And if you are on track, then you could just stick with your original budget. But if you decide that actually there's a material change, you know that you have recruited a new member of staff, or you've lost a client, then that would be the time that you would then want to do what's called a reforecast, and then you would use those numbers to help you look for the forward picture taking you to the end of the year. So the budget is your plan, and it's always a good idea to compare against that each month and year to date and for the full year. And your forecast is your revised view of the plan, and that will give you your latest expectation in terms of how the business is doing. So as each month passes, you will replace your forecast or your original budget, you will replace with actual numbers. And over a period of time, the number of actuals will increase and your forecasted numbers will decrease, taking you closer and closer to the year end. So that means that as you get closer to the year end, your view gets more accurate as the year goes on. And it also means that you don't have to wait until the end of the year to find out how your business has done, and most importantly, whether you should have taken those dividends out if you're a director of the business. And that really helps, as you can imagine, with dividend planning, cash flow forecasting, and just general business decision making. But before you jump in and actually start creating your budget, there's one thing that you need to take a look at. And you might need to work in conjunction with an accountant on this, or if you feel comfortable on Xero, then just go into the chart of accounts and take a look to see whether you have enough detail in there to help you understand the business. Your budget is only going to be as useful as the codes that you are analysing it against. So if all of your income, all of your sales goes to one line called sales, you might know whether the total sales are above or below what you expected them to be, but it's unlikely that you'll really know why. So say you run a service business with income from retainers, project work, consultancy, training and support. If that all goes into one sales code, your budget will show just one number, but split it out and you can start asking better questions. Are retainers stable? Is project work growing? Has training income dropped? So to set up a new account code, just go to accounting in Xero, then chart of accounts, add account. By default, Xero will have code 200 as your sales code. Just use accounting codes that follow on from that. So 201, 202, 203, etc. The same applies to costs. If everything goes into general expenses, then your budget will tell you very little. But if you split out your costs between software, subcontractors, rent, rates, insurance, travel, marketing and wages, well, then the budget is going to become much more meaningful. If you're unsure about what account codes to use, then have a look again in the Xero chart of accounts. There's some default ones in there. Or just use AI for your typical business. Ask it to give you a list of accounting codes that it thinks you should utilize. You don't want hundreds and hundreds of accounting codes, but you do need enough to just help you analyze between key buckets. So now let's get to the practical side of building a budget within Xero. Within Xero, the area that you want is within reporting, all reports, and then within the financial performance, you'll find Budget Manager. So within Budget Manager, you create and manage budgets, and you don't have to rely on just one version of the future. As I mentioned earlier, it's quite common to reforecast each quarter, and this is where you would set up the reforecast. Now, even though they're calling it a budget, your overall budget is your original budget. That's your base case budget. But then you could set up budgets for different scenarios. So you could have a worst case budget. You could have a best case budget, a new employee budget, a lost client budget, new contract budget. This is how you can look at scenarios for your business and work out what that means in terms of, do you need a new hire? Do you need to look at costs more carefully? Do you need to do some more marketing to improve your sales? So instead of, as is typically the case, relying on spreadsheets to do financial modelling, you could actually set up different versions of the future within Budget Manager. And the point of doing these different scenarios is so that you could model different possibilities, so that you could make quicker and better decisions if those scenarios play out. So for example, if you need to hire someone, you can look at when you need to do that and whether you can afford to do that. So when you create your budget, just choose your start date, typically the start of the financial year, and then the period, which typically will be 12 months representing the financial year. So if your year runs from April to March, then choose April, and then 12 months taking you all the way through to the March the following year. The next bit is the exciting bit. You start entering your numbers. Some will be the same each month, whereas others will change month on month. Sales might grow gradually. Marketing might increase just before a launch, and wages will obviously jump when you hire someone new. This is where it really pays to think now rather than just throwing numbers down and just doing last year plus 10%. For fixed costs, use the known monthly amount, allowing for inflation. For variable costs, use an average based on recent months. And for seasonal costs and seasonal income, look back at the last couple of years and do an estimate based on that. For your income, you could split it between confirmed work, expected work and ambitious targets. The numbers don't have to be perfect to be useful, but the assumptions that you use do have to be realistic. One of the biggest mistakes is creating a budget for the business that you wish you had, and it is totally unrealistic. So try and keep a reality check there. So let's take a simple example. So imagine you run a consultancy. You have £5,000 of retained client income. Fairly reliable, but you also do project work, and that varies. In a cautious budget, you might take the £5,000 as your business baseline. Then you add your project income, maybe starting at, let's say, £1,000 a month and increasing by £500. So your sales budget might show 6,000 in month one, 6,500 in month two, and so on. Then you add your costs. Rent, let's say 1,000, software, 300, marketing, 500, insurance, 100. Now your subcontractor costs are linked to your sales. So we'll need to vary them according to the sales. And as you can see, by doing this, you're already starting to tell a story. You can see whether your business makes a profit or loss each month, and whether profit actually improves as income grows, and whether in a quiet month that would create a problem. And most importantly, whether there's enough profit to support dividends. And you can start asking real questions. What happens if the project income doesn't grow? What happens if we lose a retained client? And what happens if we hire someone in month 6? By doing this, you're not just filling in boxes, you're actually testing the business model. Depending on the size of your budget, you might enter the numbers directly into Xero, as I've been illustrating so far, or you could work in a spreadsheet and then import it. There are loads of videos on YouTube covering how to import a budget into Xero. So I'm not going to go through it in loads of detail here, but the main thing to watch out for is be careful not to overwrite the wrong budget. So always double check the budget you're bringing in, which one you're importing versus which one you're overwriting before you press confirm. Once the budget is in place, the next thing to do is to review it. The review is where the value is. So before you finalise your budget for the year, you want to do a bit of a sense check. Are we forecasting a profit? If not, what can we change in terms of our costs, or what sales can we try and increase? And if we are aggressively trying to increase sales, how is that coming about? Are we having to hire some more people, some salespeople? Is there going to be more marketing expenditure to drive those sales as a result of an increase in sales? Am I going to have to hire more people? So you have to do a sort of a sense check, get your base budget, and then do a sense check and talking to the rest of your team to understand, what costs they feel that they're going to have to incur to deliver those growth plans as well. So it's not just a desktop exercise. That's the starting position, looking at prior year numbers, but then actually thinking about the business, how you want to grow it, and the key drivers that are going to help you with that growth. So once you've done that, hopefully you will end up with a budget that gives you some form of profitability. As I say, if you're ending up with a position that is looking loss-making, then you probably need to go back and have a look at it. Obviously, if you're a startup business, then you probably will be making losses. But that is really important then to think about your cash flow management, and obviously your budget is not telling you whether you are going to have enough cash in the bank. But if you are not making any money, then you almost certainly will be running out of cash quite quickly. Whereas a profitable business should generate cash, but it doesn't always mean that it will generate it in the time frame that you need. I'll come on to talk about this in more detail in a bit. Once your budget is in place, the next step is to review it monthly. Don't make that mistake of feeling incredibly organised, having your budget sorted, and then never reviewing it again. So within Xero, you can actually compare your budget against your actuals. So it's within reports, it's called the budget variance report, and you can select it against your original budget, but you can also look at it against your forecast as well. And it will come up with arrows, green and positive, red and negative. Don't just look at the positive and the green and red arrows. Actually look at it in context in terms of, does this make sense? Why has this happened? Was it timing? was it a one-off? Was it actually a good thing? Do we have some project income that we haven't accrued for? Retainers are higher than budget. That's good. But why did it happen? Can we replicate it? Have we used any subcontractors? Should we be accruing those costs? Marketing spend is up. Is that a problem? Or was it a deliberate investment expected to generate future sales? In fact, did it contribute to the increase in the retainers in the month? The variance isn't the answer. It's just the start of the conversation. By looking at the variances, you can work out if you've missed something in that original budget, or if the numbers are deviating from what you expected. And if that is the case, then maybe it's time to reforecast now rather than waiting until the quarter end. So now we come on to the really exciting bit. Once you have your budget in Xero, you can then turn it into a rolling forecast all within Xero. Say your year runs from April to March. By the end of May, you would have 2 months of actual and 10 months of budget. Now, there is a report in Xero under profit and loss. So in the bottom left-hand corner on Xero, you would press edit, and that pulls up your editing screen. And what you would want to do is you would want to change the overall budget, so your original budget, and you would change that to your reforecast. So let's say quarter one reforecast budget. So you'd go through and you would change that for each month of the periods that aren't actual. So April and May, you don't need to change because they will be your actuals. But then you would go through and you would change it for the rest of the year. Ideally, you want to compare your year to date against your original budgeted numbers, which is what that budget variance report gives us. But then have this forecast, which shows you what is more likely to happen, and compare the full forecasted year against the original budget. So again, you have to manually enter these into the report by adding a new column and then doing a formula to bring in all the numbers. So for the full year 2027, you would then insert a formula that then pulls in the actuals for the first 2 months and then your reforecasted numbers for the rest of the year. So your full year is then your expected position at the end of the year. And then you'd want to add a column that shows your variance, which would be the difference between what that original budget was and then the reforecast that your financial year forecast based on your actuals and those reforecasted numbers. And you will change this report each month, changing the next month to actuals and then changing the formula accordingly. So you'll have to go back into each of the columns and then update the formula. And so once you've done this, you will have your columns of actuals, your 2 columns of actuals for April and May, and then you will have your revised forecast taking you to the end of the year. And then you will then be comparing that against your original budget with a variance. And then importantly, that will then show you what your profit and loss looks like for the year forecasted versus what you originally had in your budget. Now, you need to save this as a custom report because it won't be there next time you open your Xero. So make sure you save it as a custom report with an easily understandable title, for example, full year P&L 2027, and then your estimate as at 31 May 2026. So you know at what point in time this report was created. And then next month you open up that report within custom reports and you go and change your June column to actuals, and you would then need to change those formulae in those final columns. And by doing this, as you can see, you are creating a full year projected profit and loss account that is part actual and part forecast, and then that forecast will get more and more accurate as you progress through the year. And as you can see, that will then help you estimate your year-end position much more accurately than if you're just looking at historical numbers. So, are we heading in the right direction? Is the profit what we expected it to be? Is our corporation tax likely to be higher or lower than we expected? And is there enough profit to actually support dividends? Because obviously dividends can only be paid out of retained income after tax. Profit after tax or retained income. And this is the real difference between reactive reporting and proactive management. You could stop waiting until the end of the year to find out what sort of year you had. So as I mentioned previously, one of the most practical reasons for doing this is for dividend planning. Let's look at that dividend example in more detail. So let's assume that we were forecasting around £50,000 profit before tax. So profit after tax would be approximately 40,000. If you plan to take a dividend of £3,000 a month, that would leave retained earnings of around £4,000. Let's say 6 months in, sales have actually dropped, costs have increased, and so your now reforecast position for the end of the year is only showing profits after tax of 30,000. Then that's going to change your dividend conversation. If you carry on taking your dividends at the rate of £3,000 a month, you would have then taken out 36,000 by the end of the year. And assuming you don't have any brought forward retained earnings, you are then not going to have enough retained earnings in this year to support that dividend. And so at that point in time, you will then need to start thinking about what am I going to do? Should I cut back on my dividends? Do I need to really make a push on sales? Do I need to cut costs? So you can really start to see how you can then be proactive to try and make sure that you are able to carry on supporting the dividends that you need to have or would like to have. So one thing that I alluded to earlier is that profit is not the same as cash. And this is something that I've spoken about already, but there's always a place to talk about it again. Your budget is only showing you your business model. It is only showing you, in theory, how profitable your business is. It is not telling you whether you're going to run out of cash as you carry on through the year. So it's a super valuable tool to help you understand, your business model. You need to do the forecasting and the reforecasting in conjunction with a decent forward cash flow forecast. And the two are intertwined because you can look at the cash in the bank, but without knowing what you're expected to come in, you don't then know whether actually there is stuff that is missing. So just looking at the historical numbers in Xero won't tell you that much. But if you then combine it with, okay, that hasn't gone out this month, but I was expecting it to, then you can take that into account in terms of looking at your forward cash flow forecast. So that's why the two are so important, and they're intertwined. Your cash in your bank can be impacted by, VAT, corporation tax payments, loan repayments, directors' withdrawals, customers paying late, and your supplier terms, and whether you are investing in capital. All of those things impact on cash and won't be shown within your profit and loss account. So that's why it's so important to actually look at these in conjunction with one another. So, you could have a profitable business, but if you don't manage your cash flow correctly and your working capital, you could always feel tight in terms of money in the bank. And I guess there are a few other traps just worth mentioning with this whole budgeting thing. So one of the biggest mistakes is just being too optimistic. So yes, have a best case scenario so you can model that out. You can see what staff you need to recruit, etc. But when you're looking at your reforecast for the year or setting your actual budget for the year, I would go for something that is realistic. Because otherwise, one, it will be demotivating if you don't get there, and two, if you're using your optimistic forecast for modelling the rest of the year, then that's going to be completely unrealistic and highly unlikely that you will achieve it. Another thing to just watch out for is seasonality. So sales slump in December and January, then by modelling it out, you can go, okay, well that's normal for this business. Let's not panic. But likewise, if you know that you have really, really good months in March, April and May, then that is normal, but don't go and spend all of that money because you will then need to have reserves for when your profits are down later in the year. So by doing this, it can moderate spending if you think you're you're doing really well, but also stop you from panicking in those months where things naturally do just like die off a bit. So if you're listening to this and thinking, well, this all makes sense, but I just don't know where to start, I'm completely overwhelmed with it all, then this is exactly the sort of thing that we can help you with. We have a number of fractional finance directors that work as part of the wider Artemis Clark team who can come in and help you understand your numbers as they are now, how you're using Xero, what reports you're using, tell you whether your accounting categories give you enough information for your business, and then work out what sort of forecasting will actually help you to make better decisions within your business. So if you feel that that would be useful, or you just want to have a general chat about finance and managing your finance function, then I'd be delighted to have a chat. So please just reach out to me. And as always, thank you so much for listening. If you found this useful, then please do like and share it with another business owner who may also find it valuable. So until next time, thank you and take care.